Dividends can be awesome, but they're tax inefficient. I'll tell you why. Dividend investors love being dividend investors, but there are some pitfalls. Let's get into it. Dividends are not just free money, although most people think that. Companies are actually decreasing the strength of their balance sheet, so it's really taking money out of one hand and putting it into another. And sadly, you pay more taxes. Dividends are paid out typically on a quarterly basis, although sometimes yearly. You log into your brokerage account one morning over coffee, and bam, there it is. A bonus deposit from that company. Love it.
Super duper! That's nice! Way to go, neato!
This seems like true passive income. Do nothing and get paid. And it can certainly help your portfolio if you consistently reinvest them. Some very famous dividend stocks are at&t, Ford Motor Company, Verizon, and Walgreens. But why do companies issue dividends, and should you be chasing those companies or avoiding them?
Why are you running? Why are you running?
And really, should I be investing in companies solely because they give a great dividend? And could I even live off of just dividends? Well, perhaps.
You serious?
Dividends are not gifts. Remember, when we own a piece of a stock, we own a piece of the underlying company and their balance sheet, including the cash in the company. And when a dividend is paid out to shareholders, it decreases the cash the company has and transfers it into all of our personal accounts. Companies are hoping that this added cash in your account might entice them to stay around as shareholders. That juicy dividend may draw you in and turn you from an outsider to an investor. So why wouldn't you invest in a company that seems to be giving away free money? Dividends sound like a no-brainer. But anything that sounds too good to be true very well might be. Except that one time that Andrew Garfield and Tobey Maguire came back in the new Spider-Man movie and they were all three together. That was sweet. Here's what to look out for if you're investing in a company solely based on an amazing dividend. Number one, obviously you want a nice high yield. The market average is somewhere between 1% and 2%, so above that would be great. And number two is a proven track record in history that company has been paying out that dividend for a consistent amount of time. This will help us with predicting future payouts. And three, and most importantly, does this company have the free cash so they can afford this dividend payment to shareholders?
Where's the money? When are you going to get the money? Why aren't you getting the money now?
And we got to make sure it doesn't take up too much of their free cash, because that's unhealthy as well. Remember, your dividend is not guaranteed, so be careful. It solely depends on the company's free cash flow. Dividends are paid out from the company's stockpile of available cash. And if you haven't guessed it already, negative or inefficient free cash flow means that glorious dividend isn't going to land in your wallet anytime soon. When it comes to analyzing a company, it's important to know that free cash flow helps with a myriad of things. A company can pay down debt, make acquisitions, reinvest in itself, pay that dividend, and buy back shares. And as Paul always says,
remember, I will repeat this till you're blue in the face, till I'm blue in the face. Every investment is the present value of all future cash flow.
If you really feel strongly about a company's future and fundamentals through a research process, much like our 8-pillar process, then maybe a sexy dividend company can also be a great investment opportunity. But I'll cover more of this toward the end of the video. If it's anything like the company Geo Group, then you better watch yourself.
Watch yourself!
Geo Group is a publicly traded corporation that invests in private prisons and mental health facilities. They drew people in with this massive dividend, upwards of 20% at times, then proceeded to completely eliminate it after disastrous quarterly earnings. The stock has yet to reach previous highs after leading these investors on, yada yada. So the stock crashed and you lost out on that juicy dividend you were looking for.
You gotta be kidding me.
The company said the goal was to maximize the use of cash flows to repay debt, deleverage, and internally fund growth, which is exactly what we'd want them to do as co-owners of this company. Value investors may be fine with dividends. Those who are attracted to a stock purely for its dividend might be disappointed. And those who bought on fundamentals might not even care if that dividend can't be paid out in the future. And remember, over time, the growth of the company is reflected in its long-term stock price, which can help you even more than a small dividend. Another example that upset folks recently was this whole at&t Discovery Channel spinoff. Basically, at&t owned Warner Media, they spun it off, sold it to Discovery Channel, and they made this new company. at&t in turn cut its dividend from 8.2% down to 5.7%, a pretty substantial reduction.
And I don't
like it.
This, of course, pissed off all the dividend investors, even though, like Geo Group, AT&T wanted to pay down debt and strengthen their overall company, like any true co-owner of a company would want to do. But this is a double-edged sword, because the company needs support from its shareholders and to build its fan base. The arguments against dividends are not always loud and clear here on YouTube. Dividend investors sometimes turn a blind eye as to why these aren't that great. The thing is, dividends might not even be that great of a source of income.
What? Oh, hell no. Hold up. Huh?
They are a highly tax inefficient way of making money. The companies pay taxes first, then they pay you. And when they issue you that dividend, you are then taxed again on the money you received from the company, even though the company already paid taxes on that money that was earned. But if you're like me and just figure that taxes are taxes and I'm probably gonna get screwed out of them anyway, then feel free to just go for it and make that money, baby. So while dividends might pay off for you in the short run, we personally feel you shouldn't be chasing companies solely for that dividend. Because as co-owners, shareholders of a great company, who can also get a great return on invested capital, say around 12%, meaning they take their money and go make more money with the money by expanding it, offering new products, increasing marketing, and just generally growing. As a shareholder, you really don't want that company to be paying out a dividend, especially with a low rate of like 3%. So again, my options are take that free cash and grow our company at a 12% clip, or pay out all the shareholders with that free cash at a 3% clip. This is the dilemma. If my option is to issue a payout or grow the business at a higher rate of return, I say let's grow, baby. And if you purely wanted to retire and live off dividends, here's what it would take. Say right now you make $100,000. 40 years from now, you'd need to make around $400,000 a year to keep that same level of wealth respectively, adjusting of course for inflation. So if you need 400 grand and the average dividend is around 3%, you'd need to have over $13 million purely invested in dividend stocks, and you can never touch the principal. And if all that occurred, you could live off dividends. Needless to say, it'd be pretty difficult though. So be careful chasing those dividend stocks. Make sure the companies have enough free cash flow and it's not eating up a ton of it. And I'd be hesitant to buy into companies with terrible fundamentals just for a great dividend. And if this info resonates with you, feel free to watch more of our videos of myself, Paul, and Mo here at Everything Money.